60% of the world's official reserves sit in US dollars, yet that share is slipping, marking a shift not seen in decades. The global reserve system is not collapsing, but beneath the surface, gradual pressures are quietly altering the foundations of American financial power. If the US dollar is still king, what is causing this subtle decline, and how does a currency lose influence? One quiet decision at a time. In the early 2020s, the US dollar stands at the center of global finance. Around 60% of all official foreign exchange reserves held by central banks are denominated in dollars, according to IMF data. In foreign exchange markets, the dollar's reach is even more pronounced. Nearly 88% of all currency trades worldwide involve the greenback, based on figures from the Bank for International Settlements. When it comes to international trade, the majority of cross-border contracts are still priced and settled in dollars, even for deals that do not directly involve the United States. This dominance extends across continents, shaping the way governments, corporations, and banks move money and manage risk. The dollar's deep, liquid markets and trusted legal framework make it the default choice for reserve managers and traders alike. These numbers underscore the scale and persistence of the dollar's influence, and they set the baseline for understanding how global currency power is measured, and why even small shifts in these figures can have far-reaching effects. For decades, the British pound sterling stood at the center of global finance. London's banks shaped international lending, and central banks from Europe to Asia stocked their vaults with sterling. But the First World War left Britain burdened with debt, and cracks began to show. In the years that followed, central banks started holding United States dollars alongside pounds, as the United States grew into a major financial power. By 1929, the dollar's share of global reserves nearly matched sterling's outside the British Commonwealth, a sign of shifting tides. The real turning point came in July 1944, when delegates from 44 nations met at Bretton Woods. Their agreement made the United States dollar, fixed to gold at $35 an ounce, the anchor for global exchange rates. Central banks were now required to hold dollars as reserves, embedding the currency at the heart of the system. The Marshall Plan soon followed, sending billions of dollars to rebuild Europe and Japan. By the 1950s, the dollar's dominance was clear, though sterling lingered, a legacy of earlier power. The end of the dollar's official link to gold in 1971 forced a rapid rethink of the global system. Instead of collapsing, dollar liquidity found new lifelines. In 1973, a spike in oil prices quadrupled the cost of crude almost overnight, sending shockwaves through every major economy. Oil exporting countries, suddenly flush with cash, needed a secure and liquid place to store their surpluses. Secret agreements with the United States ensured that oil would continue to be priced and settled in dollars. This arrangement, known as petrodollar recycling, meant that vast sums from oil sales flowed back into banks and treasury securities in the United States, reinforcing the dollar's central role. At the same time, the eurodollar market, dollars held in banks outside the United States, expanded rapidly. By the late 1970s, the volume of eurodollars had grown into the hundreds of billions of dollars, providing global banks and corporations with easy access to dollar funding far beyond United States borders. According to energy historian Daniel Yergin, these adaptations turned a potential crisis into a new era of liquidity, with oil and offshore finance anchoring the currency's global reach even after gold was gone. Global currency power rests on a handful of structural pillars that are difficult to replicate. At the center is liquidity. The United States Treasury market stands as the world's largest and most liquid government bond market, with outstanding treasuries surpassing $27 trillion by 2025. This scale allows central banks and investors to move vast sums in and out without destabilizing prices. Safety is another essential ingredient. The Federal Reserve's credibility, the absence of capital controls, and a strong legal system give dollar assets a reputation for reliability, even during financial stress. These qualities attract not only governments, but also private institutions seeking a dependable store of value. The network effect makes the system even more resilient. As more contracts, loans, and trades are settled in dollars, the cost of switching to another currency rises. Payment systems, hedging strategies, and financial infrastructure are deeply embedded in dollar terms, reinforcing the status quo. Finally, the United States benefits from Signierage, the ability to issue currency used worldwide, capturing economic advantages that no rival can match at scale. These combined forces make it extremely difficult for any challenger to dislodge the dollar's role at the heart of global finance. The euro's introduction in 1999 brought new hope for a genuine alternative to the dollar. Backed by the combined economic weight of the eurozone, the euro quickly gained ground in global reserves, climbing from 13% at launch to nearly 20% within a decade. Yet progress soon stalled. Political differences among member states, fragmented bond markets, and limited fiscal unity kept the euro's reserve share from rising further. The European Central Bank's efforts to deepen capital markets and promote euro-denominated assets have helped maintain its position, but the currency has remained locked at roughly 1/5 of global reserves, well below the dollar's share. Meanwhile, China has taken a different approach. Since 2009, the People's Bank of China has signed dozens of bilateral currency swap agreements, allowing foreign partners to settle trade directly in renminbi. The launch of the China International Payment System in 2015 created a parallel network to SWIFT, making cross-border renminbi transactions easier. In 2016, the IMF added the renminbi to its basket of special drawing rights, a symbolic milestone. Still, the renminbi accounts for only about 2 to 3% of global reserves. Capital controls and a less developed bond market hold back broader adoption. A senior central bank official describes these moves as measured steps, not a revolution. Both the euro and the renminbi offer alternatives to the dollar, but their gains have come slowly, limited by policy choices and market structure. The result is a world where diversification away from the dollar is real but incremental, and always shaped by the underlying strength of the institutions behind each currency. US government debt has expanded at an extraordinary pace, with marketable treasuries outstanding rising from about $5 trillion in 2008 to nearly $27 trillion by 2025. This surge in issuance has changed the structure of the treasury market, stretching the ability of primary dealers, the banks and financial firms tasked with buying new government bonds, to absorb and trade this growing supply. The ratio of outstanding treasuries to dealer balance sheets has climbed from roughly 2.5 in 2001 to over 10 by 2019, making it harder for the market to function smoothly during periods of stress. Liquidity, once taken for granted, now shows signs of strain. In March 2020, foreign investors sold a record $2.72 trillion in treasuries to US dealers as the pandemic roiled markets, causing trading depth to collapse and yields to spike. More recently, in April 2025, a wave of new tariffs sent 10-year treasury yields up 50 basis points in a single week, the largest jump since 2001, as liquidity again dried up. Foreign ownership of treasuries has dropped to around 30%, down from over half during the financial crisis. These episodes raise questions about whether the dollar's safe asset status can endure unlimited debt growth, and why some reserve managers are quietly seeking more diversified portfolios. A market structure specialist notes that the treasury market's capacity to absorb shocks is not infinite. When liquidity thins out, even the safest asset can start to look less reliable. Switching away from the dollar involves more than a policy announcement or a single boardroom decision. For global companies, every trade contract, loan agreement, and hedging strategy is built on dollar conventions. Rewriting these contracts can take years, with legal teams renegotiating terms and accountants recalibrating systems. Currency hedging, a routine part of managing risk, relies on deep and liquid derivatives markets, most of which are priced in dollars. Changing even a fraction of these arrangements introduces new uncertainties and costs. Firms must also consider whether their partners are ready to transact in a different currency, or whether liquidity will be sufficient to handle large trades without unexpected losses. The network effect keeps the dollar at the center. As long as most others use it, the practical hurdles for any one company to switch remain high. These operational frictions explain why even clear incentives to diversify play out slowly, over decades rather than months. Reserve currency transitions unfold at a pace measured in generations, not years. The shift from sterling to the dollar, often cited as the classic case, stretched across 5 to 7 decades, beginning with World War I and lingering well into the 1970s, before sterling finally faded from global reserves. For a dominant currency to lose its status abruptly, history shows that several rare conditions must align: a catastrophic loss of confidence, the sudden rise of a credible alternative, and broad coordinated action by governments and markets. None of these factors are present today. Instead, the evidence points to a gradual process, where small shifts accumulate over decades as institutions, contracts, and habits slowly adapt. This timeline helps anchor expectations. Structural change in global currency power is almost never a story of overnight transformation. Today, the world holds fewer dollars than a decade ago, but no clear successor stands ready. As global finance adapts, every shift in trust or policy reverberates far beyond borders. The next chapter in monetary power will be written not by crisis, but by accumulation and choice.